Well, hello again, Solis Wealth family. Greg Solis here with our market update. First of all, a couple of announcements. First announcement, the website is done. The Solis Wealth Management website is completed. It looks great. You got to check it out. I love it. It's definitely updated. Looks a lot better. We worked really hard on it. I hope you enjoy it. Go check it out. We'd love to hear your feedback on it. Secondly, I just got back from the so-called Summit conference with LPL. LPL does this once a year where they have their top advisors across the country all come together and meet. We went to Quinta, and it was just Monica and I, and we just had a great time. We got there a little early to enjoy the property and then had some very informative meetings with the upper management at LPL. And I always come back very refreshed and feeling good about where we are. The firm is doing great. LPL does a great job. And it's nice to get together with some old friends and other advisors and share ideas and thoughts. And so it's a great group of people, and I'm proud to be associated with them. So that was good. Market-wise, boy, it just continues to be real volatile. Last week, of course, the Fed came out with their minutes from the FOMC meeting and definitely taken more of a hawkish stance, meaning they want to try to slow down this inflationary issue. We just finished the Final Four. Of course, congratulations to Kansas. And I would say there's four things that the markets are kind of watching right now, and it's inflation, it's a consumer, it's earnings, and it's interest rates. But I think the biggest one right now is inflation. Inflation is real. This is a problem, and the Fed is committed to trying to make sure it calms inflation down. The balance sheet right now that the Fed has, they own 25% of the treasuries, 20 to 25% of the U.S. treasuries. They have about $9 trillion on their balance sheet. And what the Fed said is they want to taper on the quantitative easing and reduce their balance sheet. That will put pressure on bonds. That'll make interest rates continue to go up. We've seen interest rates go up a lot already. The 10-year treasury, just in the last 4 months, has gone from up about 1.3, 1.4, all the way up to over 2.6. That's a big move in interest rates. And as you've heard me say before, when interest rates go up, the value of bonds go down. And so the bond market's taking a pretty good hit, and the stock market's taking a hit. So we're kind of getting a double whammy. Usually you have stocks going up and bonds going down, or you have stocks going down and bonds going up. That's good. That's the counter correlation effect that we like. But this year we've had both stocks and bonds going down at the same time. Stocks have recovered a lot from their bottom, and hopefully we found the bottom, but we'll have to see. We got to watch and see what happens. But we're optimistic that we should recover, and we should continue to see a good, strong 2022 based upon the GDP numbers, consumer demand, and things like that. But we're watching closely. Again, it's very volatile, but hang in there. If you need us, of course, don't hesitate to call. We're here for you. My very best to you and your family. God bless.